Bloomberg Audio Studios. Podcasts, radio, news.
The single best idea. What a great Monday, an eclectic set of conversations. Really interesting. I want to single out Michael Purvis of Tallbecken, who just flat out said, Mag 6 is your friend. He said into earnings here and into the end of the year, he says you can't ignore the might of that revenue, that cash generation, and all the, I guess, excitement over AI. Thank you, Michael Purvis, for that. Stephen Englander in with us, and it was wrapped around the headlines in Argentina. That's not his area. We thank him and Standard Chartered for their perspective on a U.S. Argentina swap, but much more was his arch call for a resilient and stronger dollar and a weaker euro. Here, Englander of Standard Chartered.
We like our euro view, euro weakness, and we think and dollar strength. We think it will play out over that time horizon, and we think that it's we think that the market consensus is still very dollar bearish.
You mentioned dollar strength. So if the U.S. is overstating its labor growth and market growth strength, then is the U.S. dollar mispriced?
The dollar is mispriced, but not for that reason. I think. I think what what we're seeing. I mean, if you think of it, the GDP now before the shutdown was running 3.8, 3.9. It looks like labor input and correctly measured was probably down 1%. So productivity is booming. Historically, that's been a very dollar positive development.
Stephen Englander, the Standard Chartered Bank. Michael Green got us started this morning with Simplify. Michael Green with a really eclectic view. We didn't do enough on this today. I promise, folks, into the coming days, we'll spend much more time on the upset in the credit and derivative and what are called CLO, credit loan obligations markets. Michael Green on the private moment.
This is actually indicative of a much broader problem. We've been seeing bankruptcies themselves have actually been elevated in the corporate space. Those with assets above $50 million, bankruptcies for assets above $50 million have actually been surging and are at levels that are consistent with a much higher level of credit spreads. The biggest story in credit spreads continues to be exactly what you guys were referring earlier to from the SocGen observation. People are piling money in. There's not a lot of issuance, particularly in high yield, because they resist the higher yields. That means they're chasing the secondary securities and pressuring credit spreads.
Michael Green, there are so many different ways to go on this. And of course, with the leadership of Bloomberg News, looking at many of the different smaller angles in the bigger story of the angst that we're seeing in the derivative space. We're out on podcasts, on Apple, on Spotify, at YouTube Podcasts. Single best idea.